Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Having dedicated the past few weeks on Supernatural stocks to running through some local names, I decided that it's time to look back on a couple of investments that I made earlier this year, as well as a very fresh one. They all have something in common that makes them interesting. A sharp, negative reaction in the market to the release of news. That's the catalyst for me to take a long position. The first two, the ones that I put on earlier this year, have worked out beautifully thus far, and the jury is very much still out on the third one, as I'll explain. In this show, I'm covering my Process and PanAfrican Resources investments. Those were the two that I'm talking about earlier this year. In both cases, these are long positions with a long-term mindset. I'll also be taking a brief look at why I've bought the Lululemon dip, and not for the first time either. If you're going to go on a dip buying exercise, then sometimes you have to end up doing it more than once to make the trade work. That is just a reality of being willing to chase things that are falling. We begin with Process, where it's a case of in management we trust. Management teams do make a big difference in a corporate, but the extent of that difference varies, as does the impact of a change in CEO versus a change in numerous executives. For example, consider for a moment a company that has various underlying operations that have been around for a long time and have established market positions. Let's assume that this company doesn't often do deals, but rather takes a slow and steady approach to growth. In such a case, a change in CEO is unlikely to have a massive impact in the near term, because there's really only so much that executives can actually do to drive growth in a company like this. Even where there are several changes to the executive team, there will still in all likelihood only be an incremental impact. In these companies, I place a lot more importance on the underlying financials than on who the executives are at any point in time, with the obvious exception of a situation in which really poor decisions are being made and an established business will be destroyed. It is unfortunately much easier to destroy something that is already there than it is to significantly accelerate the growth rate, for example. But thankfully, this destruction is rare. Now consider Process, or Naspers if you will, same group at the end of the day, which is essentially a stake in Tencent in China, plus a portfolio of non-US based startups across various verticals. The management team at Process needs to make capital allocation decisions on a regular basis because these startups are hungry for capital and have different risk-reward trade-offs. There's also the constant allure of making new acquisitions, or perhaps even selling something off. Here, instead of backing a highly operational business, what you are really backing is the CEO's ability to assess opportunities, allocate capital, and get the right people in the right seats. This is almost a hybrid role between a traditional CEO and that of a fund manager who has a huge pot of money to deploy. In this case, the person who makes those decisions is absolutely critical, arguably even more so than the current numbers in the underlying business. Hence, when the market had a wobbly in Process in January and dished up a buying opportunity, I grabbed it. And based on the latest trading statement out of Process, it was the right call. CEO Fabrizio Bluisi is doing a great job, and I remain bullish on this company. My assessment is based less on traditional valuation metrics and the underlying financial performance, and more on the direction of travel in those financials and the narrative that Bluisi and his team puts forward to the market. So far, so good. At time of recording, I'm up 43% and planning to stay long. At PanAfrican Resources, it's a case of in the guidance we trust. Earlier this year, the company reported interim results and the market absolutely hated them. At a time when the gold sector was flying, Pan-African's production for the 6 months to December 2024 actually fell slightly. Despite the management team reassuring the market that the full year story would be fine and that they could meet guidance, the market panicked and sent the share price roughly 20% lower over a couple of weeks. This felt extreme to me, with Pan-African telling a story of a much better second half of the year, or at least their expectation for one, as well as the high likelihood of sustained growth in production into FY26 based on their projects coming on stream and being commissioned. Then why was the market so angry about what really seemed like a delay in the delivery of earnings, as opposed to a permanent problem? To add to what I felt was a total overreaction, The market also seemed to ignore the fact that an important hedge of the gold price was about to expire at PanAfrican Resources, which means that the company would enjoy the upside in the gold price in the second half of the year at exactly the time when production is supposed to go up. Based on the latest announcement by the company, they didn't quite manage to hit their full year guidance. They did still miss, but by a small amount. The second half of the year, as promised, was way better than the first half. This means that I'm currently up 32.5%, and again, very happy to stay long here. Having gold exposure feels like a good idea right now, given the broader geopolitical story. Inflation is a theme that is not going away. And finally, Lululemon, where it's a case of in the multiple we trust. I am very happy to celebrate the trades that worked, and I'm also never shy to highlight the ones that haven't. Right now, I'm 23% down in Lululemon. This is despite avoiding it when it was at truly bonkers multiples, even though there was so much temptation to jump on that hype train. I waited for the multiple to start coming down to earth before jumping in and buying with a long-term view. Well, at least I thought I'd waited. In April 2024, Lululemon had suffered roughly a 30% drawdown from where it had started the year. That was good enough for me, and I started buying. I got in at roughly $360 per share, and then it kept falling. I had put on only a small initial position because that's the thing with these growth stocks when they start falling. You've got to leave yourself space to buy more. So I added at around the $340 mark. There I was simply too quick. I should have waited because the share price cratered to around $230, at which point I decided by then to just ignore the stock and just see where the dust would actually settle in the end before I buy the dip and then the next dip and watch my money disappear anyway. Now, hindsight tells me that it would have been great to buy at around that $230 mark and then sell later on once it had rallied all the way up to $415. Those who have been trading Lululemon rather than investing in it recently could have had incredible success if they got the timing right. Now, at that $415 mark, I was obviously well in the green, but I needed a strong stomach just to get there because it would have been easy at one point to panic, sell, and crystallize the loss. And then, unfortunately, along came the tariffs and the macroeconomic mess, very quickly wiping out that post-US election rally. Now the stock is back at around the $250 mark. Such is the crazy volatility in the US market at the moment that it was also trading at this level just 2 months ago in mid-April. It's been bouncing around like mad with all the worries around tariffs and the impact that this might have on Lululemon's sales in the US. But guess what? I've now bought more. This for me was an irresistible opportunity, this latest sell-off, to bring my in price down even further, again with a very long-term lens. The reasons for this? Well, firstly, if I look at Lululemon's guidance for the full year for margins, which is what got the market panicked this time around, the management team has indicated that even under tough circumstances, they reckon margins won't really be any worse off than what we saw a year ago. In other words, what is effectively a generational reset in global trade policy might set Lululemon back by roughly a year. Not bad, I reckon. Secondly, the multiples, that's the valuation multiples, the traded multiples right now, like a PE or price sales, they are at around the lowest point we've seen in the past decade. I put a lot of importance on average multiples because for me it's the clearest way to see what the market thinks. Instead of having esoteric debates about whether something should trade at 35 times, 30 times, or 25 times earnings, I like to just compare the current multiple to historical averages. Even if you ignore the nonsensical levels that it traded at during the pandemic, the current level looks appealing versus where it's been historically. Perhaps the most fascinating thing, just to close off on this, about these three stocks that I've talked about, is that there is so much geopolitical exposure across all three names. Lululemon, that's a US and China story. Process, still mainly a China story, with a rather delightful tilt towards regions other than the US, generating some serious growth. So once again, US policies and people talking about the end of US exceptionalism, very relevant here to Process. And finally, PanAfrican Resources, that's an inflation hedge thanks to gold. I love having a diversified portfolio, and I especially love taking advantage of market volatility to cherry pick the stocks that I want to own at the prices where I want to own them. I don't think this strategy replaces the importance of consistent investing, buying ETFs, getting that broad market exposure, this is just a little cherry on top, just a layer of icing that really does make it fun in the markets and is also a great source of ongoing learnings. I'm curious whether you do the same or whether you just stick to buying consistently rather than trying to time these market dislocations. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.